Alrighty, howdy everybody. Happy Friday to ya. My name is Andrei Knight and this is Fibonacci Fridays. I hope you're in the right place. If not, but don't worry. Wherever you were heading, this webinar is going to be better. I promise. Today we're going to talk all about targets. If a trend is underway, how do you figure out how much further is it likely to go? Where do you set your targets? Where are the support resistance levels along the way? Things like that. Obviously, before jumping into a trade, you have to have some idea of how far you expect it to go. It's not always going to go that far. Nothing in trading works 100%, I'm sorry to tell you. If everything worked out perfectly, we wouldn't need traders. We wouldn't need financial markets. We would always know the best price for everything. But as it stands, we don't. The whole process of trading, the whole process of price moving across your chart is a process of price discovery. Buyers and sellers haggle it out, and eventually we figure out what fair value is for something. You know, it's really no different than going down to the marketplace and haggling with a shop owner over something, except we do it electronically. So it's useful to know how much further something's going to go. For one, to figure out if it's worth getting in or not. You know, if your stop is 20 pips away and you're 2 pips away from a reversal, that's a piece of information that you might want to know before you pull the trigger, right? You often hear traders talking about risk-reward. Well, risk-reward is simply that. How much do you stand to gain from the trade? How much do you potentially lose? The distance from your entry to your stop is your potential risk. The distance from your entry to your target is your potential reward. Piece of advice, you guys. No matter how tempting your entry signal looks like, if you're risking more than you stand to gain, pass on the trade. No matter how tempting the entry is, just pass on it. The moment risk and reward even become equal, 50-50 odds, that's called gambling. That's no longer trading. We only trade when we stand to gain more than we stand to lose. And the reason for that is very simple. I can't guarantee you a 100% win rate. Nobody can. Okay, that's just not the reality. You will always have losses. But if your winners, on average, are bigger than your losses, well, think about it. Trading successfully is just a matter of placing enough trades, and the statistics will take care of the rest. But so many people fail that one simple check before they pull the trigger. They assume if a moving average crosses over another moving average or an indicator turns red or green that they have a trade on their hands. You have to consider risk-reward. Okay? And to consider risk-reward, you have to have some idea of how long the trend's going to go. And that's what we're going to talk about today. How you figure that out. One of my favorite techniques for doing that, as the name of the webinar implies, is Fibonacci. A lot of times people get scared when you mention Fibonacci. They think it's a bunch of complicated math and it's going to be really hard and confusing. It's not, you guys. When I do this webinar live, I call it easy as ABCD. Okay, and that's not to be cute. I mean that literally. To do Fibonacci, you need to be aware of 4 points. A, B, C, and D. If you can count to 4, I can teach you to use Fibs. All right, let's get started. I'm picking an example from real-life trading because the markets themselves are the best teachers. Okay, this is a practical example from today's trading, And I picked on this one because this is a move that's not yet finished. It's still in the process of unfolding. Okay? As I mentioned, we have to identify 4 points. My goal is to figure out how much further this uptrend is going to go. Now, obviously, it's in the process of retracing down right now, right? But retracements happen along the way. We had one here too. A retracement doesn't necessarily mean the move is over. Okay, I'll show you how to answer that question once we establish the basics. Okay, but essentially we're trying to figure out how much further can this go? What's the potential on this? In order to figure out how much further this uptrend is going to go, what I'm going to do is I'm going to measure the uptrend immediately preceding. In this case, this one. Okay? So point A, the first of our 4 points, here, let me label it. Very simply, is where the prior uptrend began. Okay? Point B then, as you might guess, is where it came to an end. Let me label that guy. And I want to give you a couple notes on this. First of all, we're half done. See? It's not hard. Second of all, notice I'm measuring wick to wick. Okay? For things like trend lines, if you've attended some of my other workshops, things like trend lines, you know I like to draw them based on the bodies, because bodies represent points of market consensus. So where buyer and seller met, a transaction took place, and the candle closed. Okay? Trend lines, support resistance, things like that, I'm interested in the bodies. But for Fibs, we do it a little differently because I'm measuring distance. Okay, makes sense? If I'm measuring distance, I want to go from the furthest point to the furthest point, in other words, the wicks. And the last point I want to make on this, notice, for example, there was 2 potential tops here. Okay? When in doubt, remember this phrase, the most recent low to the most recent high in an uptrend. And for a downtrend, we reverse it, the most recent high to the most recent low. Okay? There's 2 wicks up here, 2 potential tops. I'm picking this one because it's the most recent one. Now, if you try your fib and it doesn't validate, and I'll show you how to validate it in a moment. If it doesn't validate it, then you can try some nearby tops or some nearby bottoms. But as a starting point, use the most recent ones. Okay, most recent low to the most recent high. Next thing I'm going to do once I've identified points A and B, I reach for my Fibonacci tool. I go down to the bottom of the wick on point A. I click my mouse, but I don't let go. And then I simply drag up to the top of the wick at point B, and that's where I let go of the mouse. Okay, I'm going to move this over just a little bit so we're not covering the numbers. Next, validating a fib. The first thing I do immediately after I've let go of the mouse and drawn my fib is I check for what I call snaps. And a snap can be either a body or a wick, but what I'm checking for is I want to make sure that the market's paying attention to my fib level. Okay, I only have control of 2 points, A and B. Everything else will kind of fall where it may. If I notice bodies and wicks right on my fib levels, like here, for example, at the bottom of the red candle, bottom of this green candle here, look at this bottom over here, okay, 2 candle bodies right on the line. Here, 2 candle bodies right on the line. Those are snaps. Okay? It tells me that the market movements aren't random. This fib has significance. Okay? Not just to me, but to the other traders out there. Because ultimately, it's other traders that create the movements we see on our charts. If those movements aren't random, what that tells me is that other people are aware of this fib and making their trading decisions to buy or sell, enter or exit around those fib levels. And that's what I'm after. A peek into the other traders' charts, a peek over their shoulder, if you will. Okay, that's what all of this boils down to. When are they likely to make their trading decisions? At which important price levels? Now, you'll notice there's a red dotted line here if you're using MetaTrader. This is meant to remind you how you drew your fib. If you ever need to adjust your A or your B, simply double-click on it. Double-click on that red dotted line, and you'll get little squares at each end, little white squares. From here, you just click on a square and you can drag it. Look what happens when I drag to this other high. Okay, suddenly my snaps aren't quite as good, and there aren't quite as many of them. See that? This stops ahead of the top. See that? This is not quite there. There's still a couple snaps, granted, there's wicks here, but not as many of them. But when I go to here, everything kind of clicks into place. So that's how I determine, which are the best places for my A and B, or at least verify it. Simply look for visual snaps. Next thing I'm going to do, well, actually, before I get to point C, let me explain a little bit about what you're seeing here, because very often I'll get the comment, wait a minute, your fibs don't look like other fibs I've seen. So let me explain a little bit about what you're seeing. 0% right over here is simply the same as point B. That's where I let go of the mouse. Counting down from 0, this is the percentage of the retracement. Or in other words, how far back towards A from B I've retraced. Okay? 50% is halfway. And if I move my mouse over, you can look at it visually. Yeah, that's about halfway between A and B. Okay? So this is the percentage of the retracement. Counting up from B, you'll notice the numbers also go up, but what's different here is that all the numbers are over 100. Okay? This is the Fibonacci extension. That's why they're all over 100. How much past B have I gone? Okay, so I'm not doing anything really weird. All I'm doing is using a little bit of math to trick MetaTrader into showing me both the retracements and the extensions with one mouse click. Okay? That's all there is to it. 2 tools for the price of 1. And let me give you a link to a document that will explain exactly how to do this. Okay, we've even got screenshots to make it easier. Let's see, where is it? Here. Okay, just go to that link, maybe copy it into a notepad or Word document for now. Don't go there now, because I still need your attention for a little while. Okay, but copy it into a document so you have it for later. And that'll explain how to make this modification in MetaTrader. Now, if you're using a different trading platform, you'll have to figure out how to get into the Fibonacci properties on your own. But once you get into the Fibonacci settings, you can still make use of the numbers listed. Okay? That's the only difference. B, great observation. This has been a resistance for a while, but notice it just broke. Right? Resistance gave away, and we not only broke it, but we closed above it. And that's part of the reason I'm not terribly worried about this retracement down, at least not yet. Because typically, once resistance or a ceiling breaks, the very next thing that happens is price comes back down to test it from the other side. So this was our ceiling. Now we'll see if it holds as our floor. If it doesn't, okay, I get rid of my fib and I start looking for a fib in the other direction. Okay? But if it holds as support and we bounce up, guess what? That might be a good entry opportunity for any of you that are not in already. Okay? Don't buy when price is dropping, for heaven's sakes. Wait for it to stop dropping, find a floor, and bounce back up. For example, yes, B, if it holds as support. Notice how this candle came down and came back up and left a wick. Now, it's still too early to tell. We have 37 minutes to go before the next candle opens. It'll be at the top of the hour. But if the body closes above this line and the next candle opens above this line, then this will be our entry point, as opposed to this one. It's wherever we find support and bounce back up. And if we fail to find support and keep dropping, well, then we're not bulls anymore. We're looking for shorts. Okay, then we turn it around. Will, great question. Usually it's not going to make too huge a difference. With most broker spreads, you're talking half a pip to maybe 2 or 3 pips. So it's not going to make a huge difference. You'll still be able to see if you're snapping to the fib or not. Okay. With this particular broker, we're looking at the bids. Okay. Here I've just put the ask line up in red. You can see they're right next to each other most of the time. The only time they'll really spread across really wide is during news. Okay? And during news, when you've got horribly big spreads, you usually don't want to be in a trade to begin with. You want to wait for things to settle down. Right? If you're ever uncertain of what to do, do nothing. It's amazing how much clarity one extra candle can add sometimes. And Mike, exactly. You're heading into the next part. Look at this. Candle's already above this support. If it closes above that, that'll be great. That'll be a very bullish sign. If it closes that. Next thing we need to do is identify point C, Mike. And point C, very simply, is the deepest point that we retrace to. Okay, in this case, it's right here. And a little note on this, you'll notice I'm kind of ignoring the wicks on this. Again, this can be either a body or a wick. The reason I'm ignoring the wicks is because they didn't touch 50. Okay, this isn't like rounding off. With Fibonacci, when it comes to point C, you go to the last line that was actually touched or crossed. Okay? Even if we were almost at 50, but not quite there, I would still count C as a 38 retracement. Okay? It's not which line you're closest to, it's the last line that was touched or crossed. Okay? I'm not concerned about the little bit that we overshot it by. Okay? Our point C is at 38. And basically, Fibonacci boils down to this, you guys. Measure A to B, sit back, wait and relax till point C forms, and once you know where C is, you can start to make some fairly accurate predictions of where your point D is going to be, D being your target. Okay? The most common levels that I want you to start out trading, The document that I gave you a link to earlier will explain all of them. Okay, but in the beginning, if you're new to Fibs, I want you to start focusing on these three because they happen the most often. And they have the highest chance of going to their completion without interruption. Okay? Start out focusing on these three. If your retracement, or in other words, your C, goes to 38, more often than not, again, nothing's 100% in trading, but more often than not, your D is going to go to 138. If your C goes to 50, your D is going to go to 161. And if your C goes to 61, your D will also go to 161. Okay? Those are the three that happen the most often. So, based on this example that we're looking at, Euro USD on the hourly chart, how high would we expect this trend to ultimately go? What do you guys think? $138. Great. Okay, you've been paying attention. Next question. Is this move finished yet? Not yet. Yeah, there you go. Look how much we know already. We haven't even spent a half an hour together yet. Exactly. Mike, to answer your question, do we get in at C? Usually not right on C. Because the problem is, until you've bounced off of C, you don't know that C is C. You know what I mean? Just because you come down here and paused, that by itself is not reason enough to enter. Okay? Because what if you come down here and pause, as you should, it's a support level, and then a few minutes later continue dropping? You see what I mean? The nature of a bounce is that you need to see the bounce. So usually you're entering sometime after C, after you see it in hindsight. Okay? Using no other indicators, usually I'll combine Fibs with another indicator or two to give me extra clarity and extra confirmation. But using no other indicators, some potential entry points, this could be one, because this candle opened outside and above the bullish reversal candle. Okay, that might be a potential entry. This would be a potential entry. Again, not at the bottom of the red candle, but at the open of the green one after it. Because at this point, we've established a support level. And that support level is higher than our original bounce. So either here or here, in this example, would make great entry points. Now notice something else, you guys. I'm pointing to the opens of candles. Okay? That should imply something to you. I don't jump mid-candle. And the reason I don't is for exactly this reason. That red candle looked pretty mean and scary when we started this class. Doesn't look that way now, does it? Candles have a way of changing during their life. The only candle that's not going to change is a candle that's already closed. So we make our decisions when a candle closes and a new one opens. I hate to break this to you, but this could be what you've been doing wrong. If you have a system that other people seem to be winning and you've been struggling with it, one of the biggest mistakes new traders make, they jump mid-candle because they think they're going to miss the move. It's going to leave without them. No matter how much analysis you put in before pulling the trigger, if you pull the trigger mid-candle, that is the equivalent of trading with no system at all. Hate to be the bearer of bad news, but that's the truth of it. Because whatever you use to justify your entry might not be there 5 or 10 minutes later. The red indicator might turn green. The stochastics or the moving average that we're crossing might uncross. The only thing you can base your decision on is what's already closed when the new candle opens. I recommend starting on the hourly chart because that's where I've personally found the best signal to noise ratio. Okay? But you don't have to. Pick the time frame that suits your personality the best. But as the name hourly chart implies, I only check my charts once an hour, at the open of each new candle, at the top of the hour. If you really can't sit still for a whole hour, I would much rather you go to a lower time frame and wait for a candle to open there than you take a trade mid-candle. B, you were saying there's a 200 moving average on the 4-hour chart that's hovering right at the 138 level. What does that mean? Those are called confluence points. Okay, you might have heard that term tossed around. You weren't quite sure what it means. A confluence, very simply, is when more than one indicator points to the same price level. Could be a fib and a moving average, like in your example. Could be a fib and a prior high or low. Could be a fib and a moving average. Could be a pivot and a moving average. Could even be two different fibs drawn on two different time frames. Okay? Anytime two or more different things point at the same level, you know what? That's great. I love that, B, because that gives me twice the confidence. Because not everybody out there uses fibs. A lot of people do. That's why they work. Okay? But not everybody. Some people out there use moving averages. Some people use pivots. Guess what? If a moving average and a fib land in the same spot, I know at least 2/3 of the traders out there will find that level important. See the logic? If 3 indicators land in the same spot, that's triple the certainty. So the more the merrier as far as I'm concerned. The more obvious a target is on your chart, the more likely it is that price is going to go there. Would I hedge this long position with a put option? Generally not for my intraday trades personally. For myself, you certainly can. But usually if it's an intraday trade, my risk reward is usually pretty good. Depending where my stop is, I'm usually not risking very much, so I usually don't bother. But if it's a longer term trade, one that might span a few days, absolutely. Options are a great way to hedge your positions. For those that don't know, a put is basically a bet on a lower price. Okay? And a call is a bet on a higher price. Or another way to think of it, puts are bearish, calls are bullish. And the way options work, you make a bet that price will go to a certain level. If price reaches that level, you cash out your option and make a profit. If price never reaches that level, your option expires worthless. Okay? But what makes options attractive is they usually cost a couple bucks. They're very cheap. So the thinking goes, if I go long and I'm right, I make money. My option expires worthless because my option, my put was for a short. Okay? The option would expire worthless, but you're generally making much more than the cost of the option. Think of the option as insurance, and insurance is never free. If I'm wrong on this trade and it drops, well, I lose money on the trade, but guess what? I cash out my option for a profit and I end up breaking even. Okay? So that's the idea with options. You take out an option in the opposite direction of your trade with the idea that one or the other will work out. And that's pretty much the only time I'll use options well. Naked options, I think, are extremely risky. It's hard enough to get trades right with a certain degree of consistency. Okay, but with an option, you're not just betting on price, you're betting on time too. So you have to get two things exactly right in order for it to work out. So I'm all for options as a hedge. I tend to be skeptical of naked options for general trading. That's just me personally. You know, obviously there's more than one way to skin a cat, but that's how I do it. Boyke, I'm not quite sure I understand your question. Why would I not start weekly as usual? Do you mean on the weekly chart? Is that what you're referring to, like starting my analysis on a higher time frame? Okay, just making sure. Well, I did. I did my weekly analysis on Monday, I promise. This morning I looked at my daily chart to see how the daily candles looked. You know, but we've only got 45 minutes together, so it falls a little bit outside the scope of this class. But, yeah, I call it WD-41 for short. If you want a trade to go smoothly, you spray a little WD-41 on it, okay? Every week, you know, as I implied, the open of each new candle. Every week, I scan my weekly charts, identify the big picture. Every morning, I look at my daily charts and identify the key support and resistance levels for that day. And then I zoom in further and I try to find my trades within that context. The 4-hour chart tells me the current direction, and then I go to the 1-hour chart and look for entry signals in that direction. If my 4-hour chart was bearish, for example, I would have no business looking for a long trade. Okay, so it's a great way to filter out half your trades. Usually the losing half. So I did do the analysis. I just skipped it for this class because, you know, this time around we're focusing on primarily on Fibs. But the rule of thumb, you guys, every time you have a new candle, look at that chart. Okay, so first of every month, I'm also looking at my monthly chart. Arnold, you were asking me, is there any reason why 38 to 138? Statistics. It works out more often than it doesn't work out. You know, that's all you need. You need something that's going to work more than half of the time. And statistics tell us most of the time 38 will go to 138. Well, what about the times that it doesn't? Well, the good thing about Fibs, you'll see when something's going wrong, because suddenly support won't hold as support anymore, or it might retest from underneath as resistance. So in those rare instances where you don't go all the way to D, usually your in-between Fibs will help you identify a reversal so you can get out. Okay? Realize that when C doesn't go to D, that doesn't necessarily mean you have a losing trade. It just means you might have to get out a little earlier ahead of your intended target. Solomon, your broker doesn't do options. That's okay. The vast majority don't. But more and more are starting to add them. I know Saxo Bank does options now. I believe FXDD recently added options. And I think the way the trend is going, more and more brokers are going to start adding them in the future. But again, it's not critical. I do it to hedge my longer term trades where there's more pips at stake if something goes wrong. For short little intraday trades, you know, maybe it's laziness, but I just don't bother. You know, you'll have to ask your broker if that's something you're interested in. But just a piece of advice, Solomon, master the basics first and get good at them, then add to your repertoire. Okay, don't try to do it all at once. Get good at one or two things, then add a little, practice till that becomes good, add a little more. And before you know it, you'll be all fancy schmancy. Okay, but make it a gradual journey. Just a word of advice. I've seen a lot of traders try to do everything at once and end up nothing but frustrated. And Mike, where can you get MT4? I would start with Google and just type in MT4 or MetaTrader. You'll get loads of brokers. It's one of the more common trading platforms out there. Some of my own personal favorite brokers include FX Pro. I like them because they're not just limited to Forex. You can watch stocks and commodities right from the same account as well, which is sometimes helpful. And their demo accounts don't expire, which is another perk. Okay, so maybe check them out, see if they're right for you. Different traders have different requirements. It's a very personal decision. But that's one you could look at. I also like FXCM. I've been with them for many years. Never had a problem. And FXDD is a good one. And these by no means are the only ones. There's lots of good brokers out there, but those are the three I'm the most familiar with. Yeah, I think theirs does, well, 30 days like most brokers. Most brokers, it expires. I don't know why FX Pro is so generous, but hey, you know, even if you don't ultimately end up trading with them, it's great for learning and practice. You know, and plus you can see all the other markets. FXDD, you know, here again, it depends on needs. FX Pro I recommend to people who also want to trade stocks and commodities. FXDD is a great broker if you are interested in micro lots, because you can trade micro, mini, and standard lots from the same account. Each broker has its advantages, you know, and also some have disadvantages. But start your search there and just do a Google search. You'll find many other options as well. Okay, so very simply with this trade, you guys, I'm waiting to see if this holds a support or not, this 118 level. Still 17 minutes to go. If the candle closes above this line and the next candle opens above this line, for those of you not in, it would be a good chance to get in. For those of you already in, if we establish a new support level, it might be an opportunity to trail your stop. And if this fails to hold as support, the next thing I'm going to look for is to see if it holds as resistance. And if this becomes my new ceiling, keep in mind I got in much earlier. I got in back here, so I can afford a little bit pullback. But I'm not, if I exit, I'm not going to also exit at the lowest point, right? I'm going to exit at the highest point. So if this holds as resistance, that might be a signal for me to get out of my trade for now. I can always get back in, okay? Just because you get out doesn't mean you have to throw the whole trade idea out the window. You just sit out the noise and see if there's an opportunity to get back in or not. So, man, you'll have to play. You know, different personality types. I'm one that prefers a stop to a hedge. A hedge gives me twice as much to keep track of. A stop gets me out of the trade so I can reevaluate from a neutral mindset. You know, I personally like stops. Seems like Will likes options. Every trader is different. You know, experiment a little bit on a demo account and you'll feel what flows the most smoothly for you. Okay, and Forex Stone has a point too. It ties back to my point about mastering one skill before going on to the next. Keep in mind the danger, if you're not trading consistently already, options aren't going to make you magically trade better. There is a danger that you might end up losing more. You know what I mean? So first, plug the losses, develop some consistency in your trading through practice, then add a little bit to your repertoire. If price doesn't close above the 118B, then you guys who are not in already don't get an entry signal. For me, I'm going to wait and see if we establish a new resistance level, and then I might consider taking an early profit on my trade. Okay? If you don't find support at 118 and don't get an entry B, keep waiting, keep watching, see if you find support at 0. If the bounce happens here, then maybe your entry ends up being here. And if 0 doesn't hold, remember 0 is the most important fib other than your target. That was your point B. If 0 doesn't hold, it's time to look for short trade. And also, by the way, keep in mind the time of day. Okay, we are creeping up on late in the New York afternoon. Don't open a trade on your hourly chart knowing that you're only going to make entry and exit decisions at the top of each candle. Don't open a trade on your hourly chart if the session ends in 45 minutes or 30 minutes. You know what I mean? The average trade takes 3 to 5 candles. So don't look for a 3 to 5 hour trade if there's only 1 or 2 hours left in the session. This time of day, I start to be a little more cautious and to watch the clock. Okay? Now, if you're on the 5-minute chart, that's different. You've got time for several 5-minute candles before the session comes to an end. Glenn, here's my opinion of ATR. And again, this is my own personal opinion. Okay? There's many valid ways to trade, just as there are many good traders. Okay, this is just my personal opinion. A lot of people, like, for example, let me make the example of stops. You know, sometimes people will ask me, is a 20-pip stop big enough? To which I'll answer, for what? On which time frame? You know, on a 1-minute chart, 20-pip stop is very generous. On a daily chart, it's hardly significant. So then this clever user will come back and ask me, well, how about a 50-pip stop? To which I'll answer, how about a 2,000-pip stop? It's an arbitrary level, you know, that you just pick out of your head. There's no rule that price has to move 20 or 50 pips and then turn around. And very often where ATR is applied, average true range, for those that don't know what we're talking about, a lot of times where people use ATR would be in stop placement. So then somebody will ask me, well, what about ATR? To which I'll answer, okay, now you have a very clever way of measuring distance, but you're still placing a distance-based stop. Okay? For me personally, I don't like to place stops or targets just based on distance, even if it's calculated with, you know, a mathematical formula. Exactly, Will. My stop decisions, and for anything else, Glenn, what I'm most concerned with is nearby support resistance. So for my stop, you know, for example, entering here, for my stop, I want 2 support levels between my entry and my stop. The fib might be one. I might have a moving average or a pivot in here. A prior low might be another one. 2 support resistance levels, and then my stop on the other side. So tying it back into your question, same thing. You know, I'm much more concerned about nearby support resistance levels. So more so than the ATR, if the 200 moving average on the 4-hour chart, for example, wasn't by my 138, but was down here, yeah, I wouldn't enter long right below a ceiling. Or if I knew there was a prior high from the day before. You see what I mean? For me personally, I'm much more concerned with the peripherals, the nearby support resistance level, than I am with ATR. I'm not saying it's invalid. I'm not saying it's a bad way to do things. You know, that's just my personal style. I tend to look left on my chart. I tend to look on higher time frames, and I find the neighboring support resistance level. So one potential entry would be here. For me, it might be a potential exit if it ends up being resistance instead of support. Another potential entry might be here if this holds as support. And then for a target for this uptrend, you guys, 138 would be 1.2409. And one last note I should give you guys, I never put my target or my stop right on a level. Because guess what? If it's obvious to you, it's probably obvious to everybody else. And banks love to run stops. Okay? So once you figure out a place for your stop, add a little padding. Make your stop a little wider. So if they gun for the obvious level, you don't get stopped out. Once you pick your target, same thing. Subtract a little bit of padding. Put your target a little bit shy. And part of the reason is to account for the difference between the bid and the ask spread. Okay, just like Will pointed out at the beginning of the session. Okay, you've got your spread to contend with, you've got other traders to contend with. So always set your stops a little wider, always set your targets a little shy. And plus, this is a round number, you guys. If my target is 2409, and I subtract my spread and I subtract a little bit of padding, I'm anyway going to be right near the 2400 round number. Okay? So if this continues to move favorably, that would be my target, like 2398, 2399. Okay? A little bit ahead of the target. If the turning point is between 118 and 0B, I got to give it one more candle because very likely the move's not done. This retracement took 2 candles, for example. You know, if this candle closes midway, I might have to wait for another candle or 2. Okay? But we should find support at either this or this level. I'm simply going to wait till I see it. Will, would I use American style or European style options? You know, especially in Forex, we don't always have that luxury. It's whatever your broker happens to offer. You might have the luxury of choosing in commodities, but not so much in FX. You're lucky if you even find a broker with options. But like I said, you guys, the trend is that more and more brokers seem to be adding them. How many pips can a bank run stops? I mean, it depends on the situation, market timer. During non-farm payrolls, I've seen them go 50 to 60 pips or more. It really depends on how much volatility there is in the market. Brokers aren't into losing money, so as long as they can be fairly confident it'll snap back. You know, and usually volatility determines that. Glenn, that's where ATR might come in handy, right? Because it measures the potential volatility. Here again, market timer, I don't think it's so much a matter of distance, just like my philosophy with placing stops. I don't think it's so much a matter of distance, it's more a matter of nearby support or resistance levels. Banks will usually gun for the most obvious level because that's where they think your stop is waiting. Front running, Kanka. In a nutshell, front running is basically when a broker they kind of watch what you're doing and they execute their own trades before executing yours. If they think you're on to a winner, first they take the good trade for themselves, then they execute you and more than likely fill you at a much worse price. Or if they think you're on to a loser, they'll take the opposite direction. Okay? But that's basically what it means. They take your work and they use it for themselves. The worst form of it, which is actually illegal, is if they have some insider information. You know, for example, non-farm payrolls came out worse than expected. Price just dropped 100 pips. But they don't reflect that drop on your chart. They take a short. They wait till you enter long. They delay the price feed by a few seconds. And then once your trade is open, then they show you how far it dropped. See what I mean? That would probably be the worst example of it, which in most countries now is illegal. And Boyke, why do banks run stops? For the simple reason that it's profitable. Most traders are stupid. Not you guys. You're in here learning. But most traders are losers or going to lose their money, so why not take it from them? The professional term, I used to work in a bank actually. The professional term for running stops is called freeing up liquidity. Think about it. If they get you out of your trade for a loss, right, trading's a zero-sum game. That leaves more money for them to gobble up. And trying trader, cheaper price, fairly related. I think cheaper price deals more with retracements. See, I love retracements. You know, like for example now, price dipping down, that doesn't bother me because I can re-enter at a cheaper price. Retracements are very often an opportunity to buy things that are on sale. Alrighty, so I've put up a couple links, you guys. Our time is just about up for today. Actually, it is up, but FX Street have been kind enough to let me go 10 minutes longer. Really appreciated that. Couple links, you guys, if you want to go further. My Twitter's up here. Here's my Facebook. Here's my YouTube link. Now, obviously, in 45 minutes, there's no way I can really present to you everything I've learned about trading over the years. Okay, today is focusing on Fibs and focusing on setting targets. If you want to learn the whole system, you guys, we have a series of recorded workshops that take you through it step by step. And this link actually will give you a discount off of our normal price. So feel free to take advantage of it. Here again, just copy and paste into a notepad document. And then for those of you that want ongoing daily coaching, we do live coaching sessions twice each trading day. It's already an awesome deal at its normal price because it costs less than your average losing trade for 60 hours of training for a whole month of training. What we're doing, because it's midsummer, you guys, we're going to give you a midway price break, 50% off. Not just on your first month as some kind of trial offer, but for as long as you remain a member, for every renewal. So if you've been thinking about giving our Pro Room a try and have been kind of sitting on the fence, hopefully this will convince you before you have another losing trade. Okay, don't give it to your broker. Invest it in your education. Half off, you guys. And as always, that comes back with a risk-free money-back guarantee, okay? If during the first week you find it's not for you, no hard feelings. I understand. Everybody's personality is different. We'll refund your money, no questions asked. We want you to be completely happy. So consider checking it out. We've got a sample class you can watch. You can read reviews from other students at that link. You owe it to yourself to check it out. What have you got to lose except your losing trades? Thank you all very much for your time and attention. Really appreciate it. Hopefully you got a few good tips out of today that you can apply to your trading as soon as next week. Wish you a wonderful weekend and a profitable week next week. I'll see you next time.